Hello, my name is Ajay Kumar. I'm an accountant, a CPA at Sai CPA Services.
Hello, my name is Lakshmi Sairaman, CPA. I'm a CPA inside CPA Services.
Today we'll talk about taxable and non-taxable income. More so, non-taxable income. Every type of income, you receive it in cash, check, credit card, salary, 1099, all sorts of income is taxable income. There are few incomes qualified by IRS as non-taxable income. This discussion is more about understanding what's non-taxable. Everything else is taxable. Even if you get the money in cash, it's taxable. There's no limit. You got $10, you need to pay taxes. So let's dig in. Let's talk about non-taxable income.
Child support payments were always non taxable income, but alimony payments are now no longer taxable income.
So child support was non-taxable. What changed? What made a non-taxable to become taxable for the alimony? In 2017, under the TCJA Act, what happened? They changed the rule slightly. So child alimony used to be taxable for the person who was receiving it and non-taxable or tax deductible for the person who was giving it. So why did the government had to go out of their way to change the rule? One person was paying taxes, one person was getting the deduction. But consider a situation. In a typical divorce, the person who is giving the money is making more money. The person who is getting the money is making less money. That's why they are getting alimony. That was the premise of the divorce. So the person who is giving the money is typically in a higher income tax bracket. The person who is receiving the money is in lower income tax bracket. So by giving the tax deduction to the person in the higher income tax bracket, government was losing tax revenue at a higher income tax bracket. Even though the person who was receiving the money was actually paying the taxes, but their income tax bracket was lower. So what happened? It created a tax loss. It created a tax arbitrage. So government had to go out of their way to change the rule. Now the person who is giving the money is not tax deductible for that person. The person who is receiving the money doesn't have to pay tax either. And this rule changed after January 1st, 2019. So all the divorce agreement, all the divorce settlement that were dated up until December 31st, 2018, that are still the same. They are grandfathered, meaning the person who is giving the money can still deduct it, and the person who is receiving the money, they still have to pay tax. On the new divorce, after January 1st, 2019, the rule changed.
Gifts are another non taxable income, but you can use it with some restrictions. You have some restrictions to it.
Absolutely, absolutely. So gifts are typically non-taxable to you, meaning the person who is giving the gift, they have already paid the taxes on this money. Government has certain restrictions. So right now it's $15,000 from per person to per person. For example, your dad can give you $15,000. Your mom can give you $15,000. Your dad can give 15,000 to you and 15,000 to your wife, your spouse. That being said, the limit of 15,000 is per person to per person per year. It can be done every year, $15,000, right? So gifts are typically non-taxable income. Inheritance is next item. Inheritance is not taxable. I mean, unless you are in an extreme situation, right? What's the limit? 11.4 million now?
Yeah.
So it's up to 11.4 million of inheritance is non-taxable. I mean, you are lucky if you have more than 11.4 million coming to you. That's a good problem to have. In general, for the purpose of a normal discussion, gifts and inheritance are non-taxable.
Welfare benefits are always non taxable.
Yes, yes, amazing. So welfare benefits by definitions are the benefits given to the people who are not doing well. Welfare benefits are defined as a food stamp or some sort of support given to the people who are not faring well, welfare benefits. And typically the food stamps and these such benefits are not taxable incomes.
We have to include damage awards and punitive awards.
Absolutely. So let's talk about damage awards and the punitive awards as well. So let's say, God forbid, you are in a car accident and the car has some damages, some scratches. You got $2,000 from the company, insurance company. This $2,000 that you received is not taxable. This is called damage award. On the other hand, Lakshmi, if it's punitive in nature, if the award is given to you because the government, the system, the court wanted to punish, penalize the giver, in that case, punitive rewards are considered as taxable income and tax deductible, depending on the situation, for the person who is giving the award.
Cash rebates from the dealers are also not taxable, right?
Absolutely. So if you go to a dealership, you buy a car, and you say you don't have to, if you file this form or if you sign here, sign there, go to my website, register yourself, you don't have to, you will get $50 back. That $50 that you are getting from the dealer, any sort of dealer, cash rebate, is typically non-taxable, is considered as an offset to the purchase price. So if you bought a TV for $1,000 and you got a cash reward for $50, we'll assume you paid $950 for the TV as opposed to charging taxes on that $50, right?
Yeah. We cannot forget about the life insurance proceeds here.
That's the main item. A lot of people are concerned. So life insurance proceeds, when you are contributing, when you are paying for the life insurance, that money is not tax deductible. The good thing is when you receive the money because the person happens to pass away and now you have the death benefit, the death benefit out of the life insurance are not taxable either. So it's both sides. The premium you are paying is not taxable. At the same time, the life insurance proceed you are getting, they're not taxable either.
Even the qualified scholarships are not taxable, it seems.
I'm glad you reminded me. That's again an amazing benefit. So consider an example. Your grandparents wants to pay for your child tuition fees. We just talked about $15,000 of gift limit. They can pay $15,000 to you, $15,000 to your wife, per person per year. But the school fees is $45,000. How do you go about it? The grandparents can pay the fee directly to the school and it's non-taxable. It's not considered as a gift because it's not coming through you. At the same time, let's say your daughter is going to school. The fees is $45,000 per year. But she's the brightest student. She got a scholarship of $15,000. That scholarship is not considered taxable income. That's an offset to the tuition fee she's supposed to pay. So instead of $45,000 in this example, we'll assume the tuition fees is $30,000. So these are the non-taxable benefits. In general, please understand, all income is taxable. There are few defined certain type of incomes that are non-taxable. You have to know and you have to understand the rules around it to make sure you're not taxed on something that could have been non-taxable.
Again, we thank you all viewers. I am Lakshmi Sai Raman.
And I'm Ajay Kumar. We work at Science CPA Services. If there is anything we can do to help you, please call us, write to us, akumar@sciencecpaservices.com. Thank you.